Hello, and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
The catastrophic events surrounding RZLT Incorporated, RZLT, on December 11th, 2025, they really offer a brutal lesson in the binary nature of biotech investing. I mean, we saw the stock shed, something like 87% of its market cap in a single trading session. It just plummeted from a pre-crash range near $10 all the way down to the mid $1 range.
And the volume was just staggering.
Oh, completely. An unprecedented 128 million shares traded. I mean, that's 74.5 times the average daily volume. The entire float turned over nearly 1.5 times in a few hours? So the central disagreement we need to address today is this. Was that extreme drop an entirely rational fundamental repricing, or was the sheer magnitude of the collapse, amplified by market structure failures, creating some kind of deep value anomaly?
Right.
My position is that the 87% collapse was fundamentally justified. It was a rational, if punitive, response to a near-total clinical failure.
And I come at it from a different angle. While the clinical news was obviously devastating, I believe the raw magnitude of that collapse was a structural anomaly. It was driven by panic, and it resulted in a severe market overshoot, creating a valuation that it doesn't stand up to rational analysis.
Look, the market was not wrong to drop this stock so violently. The entire previous valuation of RZLT, which was pushing towards $1 billion, was built almost exclusively on the commercial promise of ersodetugug for congenital hyperinsulinism, or CHI. The Phase 3 Sunrise trial wasn't just a disappointment, it was a comprehensive failure that functionally dismantled that entire investment thesis. We have to look at the data here. The drug missed both the primary endpoint, that was the change in weekly hypoglycemic events, and the key secondary endpoint, which was time spent in hypoglycemia. For a regulator, missing both of those metrics it's a disaster.
A complete non-starter.
Exactly. But the true clinical failure, the real killer, was rooted in the high placebo response. The placebo arm achieved a devastatingly high 40% reduction in hypoglycemic events. When your placebo performs that well, it means your drug's benefit is either statistically indistinguishable or just too small a matter. And let's not ignore the safety profile. Serious hypersensitivity reactions, patient discontinuations, and this psychosocially debilitating hypertrichosis, especially in children. This combination renders the CHI indication effectively dead. The market rightly repriced RZLT as a cash-burning microcap without a lead asset, and the 87% drop reflected that new, harsh reality.
Okay, I see why you think that, but let's look at the financial result of that so-called rational panic. The magnitude of the collapse created a structural anomaly, and the evidence for that is the valuation we see today. RZLT is currently trading at a negative enterprise value, a negative EV.
Right.
For anyone listening who might not deal with this metric every day, enterprise value is basically the market cap minus the company's cash. So if that number is negative, it means the entire operating business, the IP, the pipeline, everything, is being valued at less than zero. In RZLT's case, their market cap is sitting around $140 million, but they have $152.2 million in cash. The cash per share is $1.64, yet the stock has been trading between $1.45 and $1.60. So the market is explicitly assigning a negative worth to all of its remaining assets. This financial anomaly, coupled with that massive volume explosion, routing 37 to 40% of that volume off exchange, it strongly suggests a liquidity vacuum where forced retail selling was just structurally absorbed by wholesalers. This mechanism amplified the decline far past any fundamental cash floor, creating a genuine overshoot. And on top of that, the market is completely ignoring the robust Phase 2 data for RZ402, their earlier stage asset for diabetic macular edema. This asset has multi-billion-dollar potential, and it's basically a free option on the balance sheet that nobody's valuing at all.
So let's dig into that contradiction. How can the market logically ignore $152 million in cash? That's $1.64 per share. Even if the Sunrise failure was absolute, which I agree it was, this cash and the RZ402 asset should set some kind of floor, right?
It should set an absolute floor. The price dropping 10, 20 cents below that cash level isn't market rationality. It's a mechanical failure driven by panic. When we look at the trading data, the high volume and that significant off-exchange routing, it confirms this was massive retail panic selling being internalized.
Explain what you mean by wholesaler internalization.
Sure, when millions of retail sell orders hit the market all at once, market makers or wholesalers absorb that flow off the public exchange. These desperate sellers submit market orders, and the wholesalers fill those orders at rapidly descending prices, making a huge profit on the spread, but structurally amplifying the decline. That's what drove the price below the fundamental $1.64 cash floor. It's a trading anomaly, a structural trough, not a rational floor set by analysis.
That's an interesting point, and I acknowledge the negative EV exists, but I would frame it very differently. The negative EV isn't a failure of price discovery. It's the market rationally pricing in the expectation of value destruction. The market isn't ignoring the $152 million in cash. It's betting on management's inability to deploy it wisely, or, more likely, their determination to just burn through it aggressively.
So you're saying it's a vote of no confidence in management?
Absolutely. Consider the runway. The annualized burn rate for RZLT is steep, around $73 to $75 million. That gives them a cash runway of only about, 8 quarters. The market is projecting that management will immediately use this cash to fund an expensive RZ402 Phase 3 program, a program that could easily cost $50 to $80 million, rather than returning capital to shareholders. And why would the market be so distrustful? We have to consider the company's history of capital destruction. We are looking at a cumulative 1-for-300 reverse stock split multiplier since 2014. That is an almost unparalleled history of dilution. So yes, the negative EV is a reflection of a profound and entirely rational trust deficit. But let's follow that liquidity thread you raised. If panic selling caused the drop, we have to look at the primary counterparty. I'd argue the high volume suggests short sellers weren't the villains here. They were the smart money who saw the binary risk. Pre-crash short interest was sizable, around 10.5 million shares. Shorts who got in at $10 were sitting on enormous profits at $1.50. They were under no pressure to cover. The borrow fee was tiny, 0.55%. In fact, they acted as crucial buying liquidity during the crash. They were covering for profit, and that buying actually prevented the price from falling even further.
I'm not convinced the short covering was some kind of structural savior, because that analysis ignores the critical problem at the open, the liquidity vacuum. While shorts were rational, the speed of that 87% decline was undeniably made worse by that vacuum.
Explain.
When the news hit, we saw a classic flight to safety among market makers. They pulled their quotes or widened them dramatically, and the bid stack just evaporated. So all those market orders, the sell-at-any-price orders from desperate retail investors, were executed at successively lower prices in a vacuum of institutional interest. It's a textbook market structure failure under stress, and it created a trough that failed to reflect the true underlying value, including the cash on hand.
So the shorts may have stabilized the bottom, but you're saying the structure itself created that bottom.
Exactly. It amplified the drop far beyond what a fair market would have dictated. But leaving the mechanics aside for a moment, we need to focus on what the market is assigning near zero value to, RZ402. And this is just irrational, given the massive unmet need in diabetic macular edema, or DME. DME is treated with invasive injections directly into the eye, Eylea, Lucentis. They're painful, patients have to get them for years. The need for an oral DME pill is massive. The Phase 2 data for RZ402 is robust, showing significant proof of concept. If this drug works in Phase 3, we are looking at a multi-billion-dollar opportunity. The only viable path forward for the stock right now is a strategic partnership to fund that development. If that happens, the stock could double or triple from these levels, just based on a re-rating of the cash and asset value.
That's a compelling argument on the market opportunity, I'll give you that. But have you adequately considered the execution risk, not to mention the legal realities? Investors have lost all trust in this management's ability to deliver Phase 3 success. Their credibility is, well, it's bankrupt.
But a partner would bring in new.
But worse yet, the company is now facing active securities class action lawsuits investigating potential fraud. This litigation creates severe headline risk, and institutional investors, potential partners, they hate stepping into that kind of legal uncertainty. A partnership is far less likely until that legal cloud clears. And on top of that, any attempt at a rally will face a permanent overhang of what we call bag holders, trapped investors who bought at $9, $7. They will sell at the first sign of a recovery, and that creates relentless selling pressure that will dampen any rally.
So we've dissected the anatomy of the RZLT collapse, noting the indisputable reality of the failed Phase 3 trial. That eliminated a billion-dollar thesis overnight. The 87% drop was the market's severe, punitive response, driven by justifiable concerns over the cash burn, management's history, and the clinical setbacks.
Right.
All of which rationally justify the stock's move into microcap territory. But conversely, we've also explored the structural anomalies that suggest the market moved too far, too fast. The negative enterprise value, where the company's assets are valued below the cash in the bank, suggests a severe overshoot driven by panic selling. The question remains whether that cash floor and the promising RZ402 asset provide an asymmetrical risk-reward opportunity that the current price just fails to reflect.
The future of RZLT is decidedly binary. It's either a successful pivot and partnership for RZ402 or a continuation of the death spiral characterized by more dilution and potential delisting.
The reasons behind the price action are clear, but the resulting valuation remains intensely contested. It pits the mechanics of market structure against the harsh rationality of historical management performance.
Thank you very much for watching us. Let us know in the comments what is your opinion, and if you want us to review other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.